What's going on, everyone? Welcome to another video lesson. In today's video, we'll be going over what is technical analysis, the efficient market hypothesis, the random walk theory, fractal market hypothesis, and showing you how to test technical indicators in a platform like MultiCharts. Understand that technical analysis is not magic. Most technical indicators can be coded and tested. There is no reason for you to blindly believe anything anyone says about a technical indicator. Without further ado, let's dive in. So the first part of this video is going to be more or less explaining to you what the different hypotheses are that are against and for technical analysis working in the market. This is a very important foundation to have underneath your belt because it allows you to see the market from 2 points of view and also understand what people are talking about when they argue against technical analysis or for technical analysis. So what is the efficient market hypothesis? Is a hypothesis that states that share prices reflect all information and consistent alpha generation is impossible. According to the EMH, stocks always trade at their fair value on exchanges, making it impossible for investors to purchase undervalued stocks or sell stocks for inflated prices. Therefore, it should be impossible to outperform the overall market through expert stock selection or market timing. And the only way an investor can obtain higher returns is by purchasing riskier investments. The random walk theory is a slight derivation on EMH, but it basically suggests that changes in stock prices have the same distribution and are independent of each other. Therefore, it assumes the past movement or trend of a stock price or market cannot be used to predict its future movements. In short, random walk theory proclaims that stocks take a random and unpredictable path that makes all methods of predicting stock prices futile in the long run. Now, the only problem with this theory is well, what is a long run? And then the other method is fractal market hypothesis, or FMH. So in 2008 financial crisis, it led many observers to question dominant economic theories and perspectives on markets. EMH posits that investors act rationally and markets are efficient, meaning prices should always reflect an asset's true value. That way of thinking was questioned once again in the wake of the Great Recession. Alternative theories such as the noisy market hypothesis, adaptive market hypothesis, and fractal market hypothesis that examine investors' behaviors throughout a market cycle, including booms and busts, gained prominence. Formalized in 1991 by Edge Peters, the fractal market hypothesis was introduced as a way of creating a foundation for the technical analyst of the pricing adjustment of assets under the central premise that history repeats itself, something that the popular efficient market hypothesis fails to do. The FMH dictates that financial markets, and particularly the stock market, follow a cyclical and repeatable pattern. One thing it has in common with EMH is that both theories rely heavily on the prevalence of information with investors. From there, they take different paths. According to the fractal markets hypothesis, during the stable economic times, information does not dictate investment horizons and market prices. There are various numbers of long-term investors who balance the numbers of short-term investors, ensuring securities can easily be traded without dramatically impacting valuations. That changes in bearish markets. Suddenly, all investors trend towards short-term horizons, reacting to price movements and information. The shift causes markets to become less liquid and more inefficient, triggering crashes and crises. Perhaps the most glaring problem with quantifying and utilizing fractal market hypothesis is deciding the length of time that the fractal pattern should be repeated in a market-leading projection. So then the question becomes which one is right? And unfortunately, there is no hypothesis that is correct. The problem with each hypothesis is that it is trying to prove a negative. That means we cannot disprove or prove one is correct over the other. It is important to understand each theory before we dive into technical analysis, because you will hear EMH and random walk argued a lot against technical analysis. Either way, for me, I believe markets are pathological in nature, but the random walk people may have have the last laugh. It is very tough to have long-term success against any stock index. Those that do are very rare. I define long-term as 10 years or more of superior performance. Why 10 years? Because normally in 10 years, the market has enough up and down movements to say your method is good enough for the long haul. So what is technical analysis? So unlike fundamental analysis, which attempts to evaluate a security's value based on business results such as sales and earnings, technical analysis focuses on the study of price and volume. Technical analysis is often used to generate short-term trading signals from various charting tools, but can also help improve the evaluation of a security's strength or weakness relative to the broader market or one of its sectors. In general, technical analysts look at the following broad types of indicators: price trends, chart patterns, volume and momentum indicators, oscillators, moving averages, support, and resistance levels. It is important to note that any technical indicator that uses math to generate lines like RSI is a derivation of price. So volume and momentum indicators, those are math equations. Oscillators, math equations. Moving averages, math equations. Chart patterns, those are more difficult to quantify but can still be quantified. Support and resistance levels, arbitrary. All right, so now let's flip over to a platform like MultiCharts, where I can show you what people mean by a chart pattern, what people mean by volume or momentum indicators, what people mean by oscillators and moving averages, and support and resistance. Chart patterns are any recognizable configuration of price movement that is identified using a series of trend lines or curves or both. Keep in mind though that drawing chart patterns is highly subjective, and it comes down to how a person sees a series of data. It is also important to note that chart patterns morph as time goes on, and thus this form of technical analysis can be very frustrating for many people to learn because it is not concrete. Oftentimes, people will choose to draw lines on charts and combine them with indicators like RSI or moving average crossover or any compendium of different indicators. Although I am not a big believer in this particular type of technique, I think the only way to learn chart patterns is by seeing them unfold in real time. What I mean by this is that many people go back in time, look at chart patterns that have happened in the past, and choose the well-chosen example to learn the pattern. This is not conducive to seeing the pattern in real time and acting on it. Going back may show you the general formation, but to believe in the pattern and have the proper expectations of the pattern and have the confidence in the pattern can only be ascertained when you see it happen in real time and place money on it, or you can sim it. Market replay can be an excellent way of practicing pattern recognition as long as you choose random days that you do not remember how the market unfolded. Many people who teach chart pattern recognition do a terrible job because they do not preach about seeing the pattern in real time or market replaying the patterns in real time with no hindsight bias. This method takes a while to master, as you must train your brain to see these things and then see where price can go with managed risk. In the end though, remember the market doesn't know it has patterns. Your mind is a pattern finder, and thus you see things in random data. Now let's talk about a pattern called the V-shaped bottom reversal. To see more chart patterns and read up on them, visit stockcharts.com. Okay, so for a V-shaped bottom reversal, this is the shape we're looking for. And normally you would draw a trend line through this, something like that. You could call this also a support level. The basic idea is that you have two little mountains and a valley, and our expectation would be this: the market moves higher, or at least takes out the high of these two tips. Now, to trade this particular pattern, I have kind of a preference if I were to ever trade something like this, would be you have the V, you draw your trend line, and I'm looking for a penetration of that support level. Market comes through, moves itself back, then I want to be long and then use that as my stop loss. This is going to be my first profit target, and my second profit target is going to be the entire length of this move up or down. You can choose what you want to do. So that's kind of what the pattern looks like, how to get into the pattern, and your profit targets for the pattern, and your stop loss for the pattern. Now you can see this pattern on smaller time frames as well. For our example, we're going to be using the E-mini S&P 500 futures contract daily chart to find a V-shaped bottom reversal. Okay, so this V-shaped bottom reversal happened in 2018 from October all the way to June of 2019. And we would draw it like this. Okay, and then we would draw our support level here, and we would just double check to make sure that, does it have two humps? Yes. Did it penetrate the support level? Yes. And therefore our entry would be on this bar. Our first profit target would be the high of these two little humps here. And then you can see as the pattern morphs forward, we hit our profit target, and then the market comes back down. That's okay though, because it closes below and then closes above our support level, and then we need to re-enter near 2,800 again, use this as our stop again, and we hit our profit target again over here. So we would take one contract off. If we're trading 3 contracts, one contract off there, move 2 contracts to break even. And to get our second profit target, we would take the length from this high to this low, divide it by 2, and add it to either our entry or where we got out. And then that would put the profit target somewhere up here. So we take another contract off, and then the next half was probably up here. Now, the way I'm teaching you this V-shaped bottom reversal is my personal preference with managed risk and this little penetration thing here. But you would need to go through each pattern that you learn from stockcharts.com or books and come up with risk management around that pattern in terms of profit target and stop losses. And in this case, I gave that to you. But you will find this particular pattern of V-shaped bottom reversal on smaller time frames as well. But just remember, obviously the profits are going to be much less because you're on a smaller time frame, and this pattern doesn't always work. Now, when a pattern doesn't work, well, what happens to it? Well, what tends to happen is that it comes all the way back down to what I call the scene of the crime, or the SOC. And that can also be something where you're like, I don't have confidence that this is going to work, and maybe you short sell this, and then your profit targets would be inverted. You could also see this V inverted to the sell side, where you would just take this pattern and flip it up. So it would look something where it's like this, right? And the rules would be just to the sell side. So I don't want to belabor chart patterns, but you can see how subjective this is. But if you add rules or methodology around a pattern as it morphs, you should be okay. And remember that patterns like this are just from your mind. They're not real. So don't put all your faith into any particular pattern, because this is highly subjective. Okay, so now let's talk about support and resistance. Support and resistance is very simple. You're looking to connect 2 lows and 2 highs to basically create almost what looks like a rectangle. So I could say that this is support and this is resistance, and I could color code this in one thing and color code that in another. Maybe I make this green and this red. So what's interesting about support and resistance levels, in my opinion, is that support and resistance levels are more stable than drawing lines that are diagonal or up and down like we did with the V-shaped bottom reversal. And what I mean by that is that if I were to use MultiCharts support and resistance levels using a horizontal line like this, in like this, I could change the scale and this would not change. If I were to draw a diagonal line, for example, like this, and I were to change the scale to, let's say, a smaller time frame, like a 30-minute chart, then this line would intersect in weird places, but these lines would still be the same, connecting those points. So that's just something to keep in mind when we do support and resistance. And when I draw support and resistance on a chart and it creates a formation like this, I call that a range bound market. And in order for a range bound market to be valid to me, I look for 2 touches at the top, 2 touches at the bottom. And so this would be 1, this would be 1, this would be 2, this would be 2, and then anything over here I can use to play off of. So I look for, again, a penetration of the low. I get long here. First target is the midline, second target is the high. Last target is a runner target, basically, that I could use the high of this and the low of this, divide that by 2, add it to this area, and then that's going to give me a profit target, usually somewhere in there. Okay, so now let's move on to volume and momentum indicators and oscillators and moving averages. And these things are more concrete than just drawing lines on charts because we can actually program these things and backtest them. All right, so now we're going to talk about indicators, and indicators can be anything from volume to RSI to moving average, crossovers, or moving averages in general, Ichimoku cloud. There are hundreds, if not thousands, of indicators that exist, and when you are thinking about indicators, it's best to think about them in terms of like families. So RSI is a momentum indicator, and there is also an indicator called momentum. However, if you are creating a trading strategy based off of momentum using RSI and momentum, that's probably not a good idea, just because they both kind of do the same thing. So when you are creating a strategy in general using indicators, it might be best not to combine like indicators. And the same would be true if you were using indicators on a chart. You need indicators that give you different information about the market, not repetitive information like having an RSI and momentum. Maybe you have RSI and then you have a sentiment indicator, plus you have a structure like a range bound market or a V-shaped bottom reversal, which is technically a chart pattern. You combine those things together and then you place a trade. Just food for thoughts. But with indicators in general by themselves, like moving average crossover, where a fast moving average crosses a slower moving average and you buy or sell, these types of things can be programmed and tested. When someone says, hey, I have an indicator for you, ask for the back test of that indicator, because it is 100% possible to program it, test it, and see if it has any validity. So for our example, we're going to be using moving average crossover, which is 2 lines. And basically the idea here is if this line intersects or crosses this line, then we buy. This line here would be considered the fast moving average, and this line here would be considered the slow moving average. And when they cross each other, this would be a buy and this would be a sell short or a get out. Very simple and easy to program. In MultiCharts, you can actually see the coding language, which is called power language, and this indicator comes in terms of a signal, and as well as a study, and a signal is basically code that can be back tested. So these are the rules, and we can set the lengths. Now we're going to set the lengths to something that a lot of people think is good because of CNBC, and we're going to do what does a back test look like if the 50 period moving average crosses over a 200 period moving average and we buy. And our sell rule is going to be the inverse of that, which is SE. So this is a sell short, and it's going to be 50 to 200 like that. And now this is sell short and this is enter long, and then we're going to close it. And this is going to appear usually in your platform when you set the window or the look back period to such a long length. And then you just go into properties, and we need to set this to 250. That's the look back bars considered. turn the status on and close. And what you're going to see here is that it automatically plots the entry and the exits on the charts. And we can click this button up here, which produces a backtest of this strategy going long and short, and you can see it has taken 24 trades in its entire history. And you may say, well, Matt, this looks like it works. Why would you hate on this? Well, I hate on it because it is, one, a very, very low sample size. We only have 25 trades. Number two is, like, the long side is the most prevalent of the profits, and the short side, it loses its butt. So it's just bad overall. It's not a great strategy, and it's not something you should really listen to. And you could also say, well, this is long short. Like, what if I buy and only hold for a couple of days or XYZ thing? Sure, then maybe you iron this out and you make it work. But that's not what CNBC is talking about. That's not what they're saying at all. They say, well, when this crosses that, then it's bullish and you should just be going long. There's no real detail that they give you. But my point is this: because developers are amazing people who created trading platforms, you can test anything you want. They've set up a structure for you where you just literally have to learn to program, and you just drop your code in and you can backtest strategies, and you don't have to listen to me, you don't have to listen to CNBC, you don't have to do anything. You can hear an indicator, you could hear an idea, you program it and you test it, and that's it. And it either works or it doesn't, or you tear apart the strategy. So that you can see how concrete this is in comparison to all the things that we talked about. And in my opinion, this is what you should be doing with anything you hear and anything you trade. You could have patterns, okay, that morph, like chart patterns that we talked about, mix them with different families of indicators like oscillators, moving average, support and resistance, all these things. So you have structure plus context, and then you trade, and maybe you're successful doing that. But if you're going to build a system, or you're going to rely on indicators, like those indicators that you use, even if you are drawing chart patterns, you should know what the edge of those indicators are and make sure that they are diversified and they're not just looking at one specific thing or redundant. So that's going to do it for me. Hopefully you guys enjoyed this video. If I didn't explain anything well, please let me know, and I'll try to do maybe an updated version of this video, but hopefully this helps. Peace. What's going on, everyone? Thank you for watching this video. If you like this video, please click subscribe and hit the bell notification. Remember, it's not enough just to subscribe anymore. For some fangled reason, YouTube makes you click 2 buttons. That's not my fault, okay? So you have to click subscribe, and then if you want to get notified on new videos, you have to turn on the bell notification.